Let's look at transportation and logistics. Our guest is Ari Rosa, an analyst at Citi, specializing in North American transport and logistics. Ari, thank you very much indeed for joining us right now.
Thank you for inviting me on. Nice to be with you.
Let's jump into it. UPS, the giant courier, you see upside here. Why is that?
Yeah, so UPS is in a bit of a transition. It's had a challenging start to the year, no doubt. A lot of people are concerned about the volumes, but the reality is, look, a lot of things in transports have kind of moved into the value camp. I was talking with someone the other day, an investor the other day, who was saying this kind of feels like a value investor's paradise right now. And UPS is pretty high on our list, where you have, on one hand, you have a strong balance sheet, and you have a healthy dividend. You have almost a 6% dividend for UPS, and then second, you have this resource rationalization that they have underway, which we think provides a lot of support to margin. You have this transition where UPS has gone from an environment where they've been chasing volume growth to now they're really a lot more focused on pricing and on margin improvement. And we think that transition actually is quite healthy for them. And I think that actually could provide a lot of support for EPS, especially if we have a condition where the economy starts to pick up a little bit. UPS has really been hurt by the soft economic environment and the soft demand environment. And so if we see some pickup in demand, I think that actually could be extremely supportive to UPS earnings.
CSX, the railroad company, what attracts you there?
Yeah, so CSX, in some ways, a similar narrative where, look, they've had some short-term challenges, but CSX, on a fundamental basis, the railroads in North America, and you obviously know in Canada, you have a couple of big railroads up there as well that we cover, but railroads in general are some of our favorite businesses. They're phenomenally good businesses over time. They tend to compound at really attractive rates, very durable, large moats around their businesses. CSX right now is facing some challenges where it's doing some rebuilding, so has a couple of construction projects underway that are holding back its earnings. But we think once they get past that, really in the second half of this year, we think there's quite a lot of upside potential for their earnings. And again, for a really durable business, you're not paying a particularly rich multiple right now.
I guess there's going to be worries about trade, though, hanging over the railroads, especially for our railroads here in Canada, because we're so export and import oriented. Is that going to make investors reluctant, do you think, for the next while to buy into these stocks?
Absolutely. So that's a totally legitimate question. I think, in the case of CSX, actually, one of the reasons we like it is that it has a lot of exposure to U.S. manufacturing. And so if you look at the policies, at least that Trump says he's advocating for, that he'd like to push, which is really kind of a reindustrialization of the United States, that bodes extremely well for CSX. We've actually previously suggested that pairing Canadian Pacific with CSX is actually a really nice way to hedge some of that risk. So Canadian Pacific, great management team, obviously cross-border franchise, historically has been very well run, and also has some of these opportunities consistent with its integration of Kansas City Southern, which it acquired a couple of years ago. And so we think there are ways you can kind of mitigate that within the transport space, but we actually see CSX as less exposed to tariff risk than many other names in our coverage.
I see you do have buys on our two big railroads as well in this country. And then finally, TFI, the trucking firm. Why has this one caught your eye?
So TFI has had a really tough start to the year. It's actually down the most in our coverage, but we actually, consistent with this idea of bottom feeding, dip buying, we actually see quite a lot of opportunity there. So TFI historically has been a great compounder, strong management team. I think they ruffled some feathers in Canada when they suggested that they might re-domicile into the United States. They obviously have since pulled back on that plan. But historically, TFI has been a very good business. For a company that has about a $7 billion valuation, it throws off about $700 million a year of free cash flow. And I would argue that that's a cyclically depressed earnings number, just given some of the weaknesses here. So TFI definitely has some speed bumps, some challenges here in the near term, especially if the Canadian economy goes into recession. But TFI, over the long term, I think TFI is very well positioned to continue to generate free cash flow, to continue to grow earnings. So we like it a lot here on some share price weakness. We think there are opportunities for investors who have a little bit of a longer time horizon.
We heard talk, this is going back more than a year, of a freight recession. Was that partly because there were too many trucking companies out there?
Yeah, that's exactly right. So the reality is we've been in a freight recession for quite some time. Even though the broader economy has been decently healthy, we've really had a freight recession for the past 2.5 years. And there was a lot of hope coming into the year. There was a lot of hope that the freight recession was going to end. Finally, this capacity rationalization had taken place. And the reality is now that we see a little bit of consumer weakness, now that we're seeing industrial activity perhaps tend to wobble a little bit. Those fears have reemerged, and it's really the reason that a lot of these stocks have kind of underperformed year to date. But from our perspective, at least, we think there's real value in transports because the reality is a lot of these businesses are durable and will survive past the cycle, even though they have some near-term challenges here.
And we've only got 30 seconds. Alain Bedard at TFI, a pretty strong reputation for pulling off takeovers, M&A.
Yes, absolutely. Yes. And so, again, I mentioned earlier that a lot of free cash flow generation at TFI. Historically, what TFI has done with that free cash flow is take it and deploy it towards accretive M&A. And they've had a lot of success with that strategy. They've run into some speed bumps here because they got into US LTL, and that's faced some challenges. It's been a tougher turnaround story, I think, than they anticipated. But over the long term, again, Alain is a very good CEO, and I think he's very good at identifying problems and figuring out where solutions need to be found and how to fix those problems.
Ari, thank you very much indeed for joining us.
Great, thank you.